With that, we now move on to our breakaway session. Ladies and gentlemen, we now move to our breakaway session 1 with its title as Keeping Individual Centricity in Group Lending Model, the newborn of microfinance. Please join me as I request our esteemed speakers of the session to kindly join us onto the stage. May I invite on stage the moderator of the session, Ms. Deepshikha Sikarwar, who is the Associate Editor and National Editor Economics, The Economic Times. Very warm welcome to you, ma'am. May I now invite Mr. G. Kiran Kumar, who is the ED and CEO of Svamaan Financial Services. Warm welcome to you, sir. I also request Head Wholesale Bank IDFC First Bank, Mr. Paritosh Mathur, to kindly join us onto the stage. May I request Executive Director Dvara Research, Dr. Indradeep Ghosh, and I also request Partner PwC, Mr. Asim Parashar, to kindly join us onto the stage. Ladies and gentlemen, this session will focus on the future of the group lending within microfinance, a model that has been instrumental in providing financial access to underserved communities. With those words, may I request the moderator of the session to kindly take over, and over to you, ma'am.
So good afternoon, everyone. This is a post-lunch session, and I think it was highlighted earlier as well that it's difficult to do a session soon after the lunch. But nevertheless, we'll try to make it interesting for you. We have a very stellar panel of experts who've been engaged in the sector, in their fields, in their own way. And one very issue which the industry, which the sector is grappling with, this transition from group to individual is what we would be discussing with. So without much ado, I want to start with you, Kiran, because you've been a practitioner. And when we talk about the transition from, you know, the power of group, which microfinance has sort of, it's been the pillar for microfinance when we talk about transition from group to individual levels. As a practitioner, how do you see that happening?
Hello, yeah, thanks a lot, Deepshikha. So I think the microfinance sector has grown on the backbone of the joint liability group construct, right from the time of Muhammad Yunus, if we go back to the 80s, right, and the SHG movement. And the growth in India specifically started when we took out the savings element and directly went to group lending. And it simplified the process for the borrowers, and also for the sector, it became very easy to access all the customers. So post-COVID, I think there has been a significant shift in the model. So I think it started with COVID restricting, large groups aggregating together because there was a risk from the COVID disruption that was happening. So that kind of started destabilizing some of the group dynamics in terms of the collection meetings. And then the current crisis over the last year has further deteriorated the group culture, where customers are more and more going towards asking questions around, why should we be liable for, some of my peers who are defaulting when the loan is taken by me. So I think the transition that is happening today is obviously, if you look at the joint liability group construct, the liability part of the equation is going away, but the group still stands strong because you have to serve these customers, and because the ticket sizes are very small, it's easier to serve 10 customers at a single place rather than a single customer who is taking a 50,000 loan. So the group construct still continues to be strong. The liability construct is going away. I think that is the trend of the sector that we are also seeing at Svamaan. And on the other side, the individual transition that is happening is twofold, right? One is now more and more we are underwriting customer as individuals. So that is happening because we are looking at the individual's credit score, we are looking at individual's OD status, number of loans that the individual carries. no more is the group the core of underwriting, which used to happen earlier. Now it's all about the individual, and if they qualify the guardrails, if they qualify the credit policy, only then they are getting the loan. I think that shift has accelerated considerably now.
Paritosh, from your end, and before I actually ask you the question, I think there's a video which you'd like to play.
Yeah, you know, just to sort of get the ball rolling, I thought we'll play out a quick clip in case it's ready, and we can do it.
जिंदगी के कई मौसम अनुभव किया मैंने। हालात बदले, लोग बदले। अगर कुछ नहीं बदला तो बाबूजी की सिखाई हुई एक बात तो कहते थे, जब नींव मजबूत हो तो फिर चाहे वक्त के उतार चढ़ाव कैसे भी हो, हम उनका डट कर सामना करने में सक्षम होंगे। बिल्कुल इस पेड़ की तरह जिसकी नींव भी टिकी है निस्वार्थ भावना और सहनशीलता जैसे आदर्शों पर। ऐसा ही एक अटूट रिश्ता जोड़ता है आपके साथ IDFC फर्स्ट बैंक। विश्वास, पारदर्शिता और सच्चाई का। ये है ऑलवेज यू फर्स्ट, क्योंकि इनको आपकी सफलता में अपनी जीत दिखती। मैं तो जुड़ चुका हूं इनके साथ, आप भी जुड़ जाइए ना। IDFC फर्स्ट बैंक, ऑलवेज यू फर्स्ट।
So let me just quickly bring the context in here, right? I wanted to sort of play this when I was told that I have to come and be a panelist with this particular forum, and this is something that we put out towards our clients and even retail customers back in 2019. You know, when we were forming the bank, and at that point in time, we wanted to establish the pillars of trust, the pillars of you being first, you know, and ensuring that we build the bank around that. And I wanted to pull this in from, you know, the discussion topic otherwise is very different going from JLG to an individual loan. But I want to bring my perspective, which is more towards being a second order engager with the concept of JLG, where we are a banking lender to microfinance NBFCs, and they are in turn, you know, doing their hard business of basically doing these rural retail loans. So from our perspective, really our engagement with microfinance industry is predominantly based on not the product that you are doing, which is a second order aspect for me, whether you're doing it through a joint lending group mechanism or any other mechanism of lending, but more to do with the first order elements that we would like to be sure of when we are engaging with any NBFC you know, entity, which is, can we really trust the you know, the board, the founders, the CEOs, the management of these entities for what they are looking to build in the NBFC microfinance world. Thereafter, the money that we lend is acting more like a work capital for you, or the lending that banks provide, and at least I can say for sure that these views that I'm expressing, I can't say that it's a generalized view for all of the banking industry, but I can surely say that this is the view that we've been taking at IDFC First Bank, which is that the money that we are lending to you is more to do with, you know, the nature of it is like a working capital, and it's not a money that's meant for absorption of credit loss. The absorption of credit loss really needs to be coming from the equity component that is sitting on the balance sheet. So we are a participant with all those entities where we feel confident about the presence and the growth of equity. I think that drives the sort of first order engagement that we would love to have with, why only NBFC, MFI for that matter, the entire NBFC industry. Now, from a second order perspective, and just getting back to the core topic of JLG versus individual, our take is that as a bank, any bank for that matter, we are as it's an assumption for us that the microfinance entities have been lending under the JLG framework. But just as like that, we are also comfortable with providing debt funds to those NBFCs which have a individual-oriented lending framework, whether it's towards micro businesses, or it's towards consumption loans, or it's towards asset-creating, loans. So I think for the banks in general, what will be critical is that we would ideally like to not see a very sharp transition that, oh, just because we've gone through a credit challenge over the last 6 quarters, let's just shut down the JLG model and we are only going to do individual lending. I think we need to have some kind of a hybrid outcome, and a transition that's taking place carries forward in a stable way. We've already seen a lot of dilution, to what Kiran also mentioned, that from the start of the industry to now, there has been a dilution in the value of credit protection that the JLG concept provided. We are all aware of it, and to that extent, if it's moving towards individual, at least as a bank, I can say we are comfortable on both sides. However, JLG does give a very, very important contribution towards the management and the control of operational expenses for these entities, because you get a lot of people, or at least the JLG women members, come into a center, and that discipline sort of helps also manage the operational expense side. So long as we can come out with solutions that do not bloat up the operational expense to, that to become another issue with a return on assets kind of an outcome, I think as a banking industry, my first sort of say here would be that we would be very comfortable either way.
I was just going to ask you, in terms of risk and attractiveness, where do you see both the models?
See, like any banker would say, the most attractive model is go secured, but this is all within the unsecured arena. I guess that the responsibility of somebody else's liability being borne by a group of people is a concept that, as you scale in size or in size of loan per group, is bound to get diluted, right? So mentally we have to be prepared that that it's something that has to move out. But if I have to cast a vote, I would say secured is at the topmost pedal, and any kind of a co-obligor structure, which is legally bounding, is the next. This is like a social co-obligor structure that was in play, and fine, we've had a great time building an industry on it of 4 lakh crore plus worth at its peak. And I think to the extent that we can mold it into something still remaining very useful, it will be a great outcome.
Asim, if I could come to you here, you've heard a practitioner, you've heard someone who supports the sector from the other side. You've been advising the sector, you've been a keen watcher. How do you see this transition happening, and what are the risks that you see here?
Yeah, it's almost like looking into the future, but I will try my best to answer that. My assessment is that both the model will coexist, and in the morning I was discussing with one of my colleagues. So the process that I think will evolve, or what the industry is looking at it, is that if you graduate from JLG to individual, and you default there or due to some reasons, etc., because it's new for you also, and then again you can come back to the JLG to build your credit history. Now this is one of the model which we believe can evolve as we go along. But let me just take a step back. What was JLG model doing? It was almost working as a credit underwriter for you. They were trying to kind of underwrite based on the behavioral and knowledge about each of the individuals, and hence they were underwriting for you. But now with the education, second generation, third generation of that particular group of people, they have been educated. There have been a lot of subsidies on education, giving cycles and other things, etc. Now these people are also influencing their parents, or that particular cohort of customers, that why you are trying to take a JLG. For them it may be a below dignity, etc. There are a lot of behavioral aspects which is playing in. And we were talking today that Grameen score and other things which are coming up. Way back when small finance bank were being set up, we talked about and we advised one of them to use alternate credit data. For example, fertilizer distribution is limited. The fertilizer factory has a zone, and the zone has distributors for a particular zone, and that person knows each and everything, who takes it on credit, who returns it on time, and cash. Now, those information could have been used. We are still talking about those data, but it is still high touch. The model is still costly. So as long as there is a price differential in the model compared to the money lenders, we will see a transition. If not, then people will shift. So that's my thought process as of now.
Thank you. Dr. Ghosh, from your end, when you're doing policy research, when you're looking at this sector, from customers who are, and from companies' point of view, what are the risks in terms of indebtedness that you see when you are transitioning from the group to individual models?
Right. So thank you for inviting me to be part of this panel discussion. So just to give the audience some context for what we at Dvara Research do, we are a non-profit policy research and policy advocacy foundation, and we do research and policy advocacy in the financial inclusion domain. We have been doing this for about 17 years now, and we focus exclusively, almost exclusively on financial inclusion and not any other policy issue. So we have a lot of expertise about the financial inclusion landscape and especially about microfinance. So what we have seen, at least from past work that has also been done on this question of whether individual underwriting or group underwriting makes for better repayment rates, at least the research is undecided. So only a few years ago, in 2022, there was a review article that was published by some of the leading researchers in this domain worldwide. And in that review article, about 20 years of research was reviewed in that article. And there was a small section in that article about this particular question, whether group lending actually makes for better repayment rates. And the reviewers concluded that it did not. Okay, so the perception has always been that group lending makes for better repayment rates, but nobody has actually tested this hypothesis. The way to test this hypothesis would actually be to set up some kind of pilot where you make group loans and you also make individual loans to more or less similar cohorts, and then you observe them through time to see if one is repaying better than others. But that kind of work has not happened. That kind of study has not been done. Recently, some work has been published on moving customers from group lending to individual lending in Philippines. And there also, the researchers find that moving customers from group lending to individual lending does not impact repayment rates. Repayment rates continue to be more or less the same with individual lending as with group lending. And what, one of the things that I have also written about this, that there is a difference between the kind of group lending that happens with the SHG model and the kind of group lending that happens with the JLG model. Because SHGs pre-existed, they existed before microfinance came on stream, and SHGs really came together as mutual aid groups, so these were women who were helping one another. And on top of that, you decided to make bank loans available to these SHG groups. So essentially what you were doing was you were overlaying what already existed as a mutual aid group. You were overlaying on top of that mutual aid agreement an economic commitment or an economic obligation. But that has not been the story with JLG. JLG groups have not come up, have not, at least to our understanding, have not come together organically in the same way that SHGs had come together organically in the 70s and 80s. In the case of JLGs, what was happening is that first you were bringing the group together in order to disburse the loan, and then there was some kind of agreement among the members of the group that they would monitor each other. So it was exactly the reverse of SHG. So in a way, I would say that the JLG construct has always been something of an artificial construct. And we at Dvara Research don't really see much risk in moving from a JLG model to an individual model, with all the necessary caveats in place, which is that credit underwriting should still happen in a responsible and meaningful way.
Kiran, what has been your experience? I mean, you just heard Dr. Ghosh. You are a practitioner. Do you see that on the ground? Or are there any precautions that you are taking as an entity?
Yeah, so I think one point that I would like to highlight also is beyond the repayment rates, when we are actually going on the field, one of our biggest constraints when we are giving this loan is also cost to service, right? So when we are giving a 50,000 loan to 1 lakh loan, or majority of the microfinance portfolio is still sub 1 lakh. So the biggest transition that happens going from a group to an individual is basically the cost to service. If you have to do individually, the product is not sustainable because you cannot afford to go door to door and service all these customers. Even though the repayment rates might be the same, but you practically cannot service those customers at the rate at which MFI loans are being given, right? And from our side, we have internally also looked at the product constructs that best serve the market that we are catering to. So if you're talking about bottom of the pyramid customers, what was the gap that microfinance was supposed to solve for? The gap was basically how can you give easy access to capital without any collateral? And you help these customers build the collateral using our loans, right? That was the purpose. Now, just going back to the Philippines example, if you notice, a lot of the press in Philippines is now talking about how microfinance has been, taking over a lot of the loan against property loans, and a lot of these customers are losing their properties now because they are not able to repay the loans, right? Now, that was not the intent of microfinance at all. It's not the intent of microfinance to, deplete the assets in any situation. So there needs to be a journey of each customer where they are becoming more financially literate, where they are becoming more accountable, and then you expose them to some of these next generation kind of products where they are able to accountably take these loans. Otherwise, it causes more damage to the households than serving them. And even if you look at today, right, we talk about a lot of individual loans, MSME loans that are being given. If you compare the rates, there are anywhere between 4 to 5% higher with worse terms in the market, where a microfinance loan could have served them better. So, and that's not because, the entities are not ready to give a better product, right? It's just that the cost to service is not feasible on an individual construct. So they are ending up with a higher rate. So in this situation, I think the demand and the product construct of a microfinance is still one of the best, and India has one of the lowest rates as well. There is no prepayment penalty that any of us entities charge, and there is no collateral requirement, which was the intent of the product. So this product still functions as a great entry point for a lot of these bottom of the pyramid households, who then need to be transitioned based on their maturity, both on income and financial literacy, to more mature products where they still take loans based on the capacity of the household. So I think that is the most critical problem to solve for as we go forward.
If I could come to you, Dr. Ghosh, when you are in the advisory segment, what would be your advice here to what Kiran said? At individual level, when we're talking about transition happening and when these concerns are being flagged out, what are the cautions or what are the measures that entities need to undertake while they transition from group to individual, right?
Right, so I actually, the point about individual loans being higher cost to service is well taken. I also think that what was said earlier about hybrid forms being necessary as a pathway to individual loans is also a very well made point. I don't think that the transition can happen discontinuously. The transition has to happen and will happen, as all things do happen, continuously through adaptation to new circumstances and new regulations and new situations. Now, given all of that, I think the challenge of you see the downside of a JLG or a group loan was always the lack of product customization. And so that becomes a useful dimension to explore for lenders who are now going to make individual loans, and that kind of product customization could somewhat compensate for the higher cost that an individual loan requires for its servicing. But in making that individual loan, I think that financial institutions should really care a lot about the maturity of the borrower, of course, but also the use that that loan is being put to. So I think one of the things that doesn't get mentioned enough is that even though the promise of microfinance has always been to encourage livelihood generation and to encourage movement out of poverty, it is the case that a lot of microfinance is used for consumption purposes, and not always for the consumption of necessities, often for the consumption of luxury goods, which are status goods. And the consumption of status goods can spread very, very quickly within a community, simply because the way that status goods consumption spreads is through imitation. So I see somebody else buying a smartphone or an AC or a bike, and I want to get one too. So I think one of the issues that we don't know enough about, but from a research perspective, I can say that we worry about this, which is that, what are microfinance loans being used for? Even within the JLG construct, I would say that microfinance loans were often being used for consumption and not always for consumption of necessities. So not for consumption smoothing. Often it is used for consumption smoothing and sometimes for enterprise purposes, but often also microfinance loans are being used for consumption of other kinds of goods. And so I don't think the challenge disappears with individual lending. In fact, it becomes even more present with individual lending because if there is any group pressure which prevents borrowers from, in a group setting, from spending microfinance loans wastefully, then that pressure disappears in the individual lending context. So I think really the challenges on the credit underwriting front are formidable with individual lending, especially if the lender is serious about microfinance achieving the aim that it is supposed to achieve.
Asim, do you think the entities would now require some operational redesign to sort of handle this transition at individual levels? What have you been advising some of the entities who are undertaking or who are undergoing this transformation?
So definitely yes. There are two things which are important for them, that all the interactions at the customer level or the customer touch point should be captured on one particular digital channel. Some information will be just in a dormant manner or in a very static manner can be captured, the GPS location and other things, etc. And the interactions that are they doing, plus alternate data which will require micro-segmentation. So if there is a climate stress or if there is certain event which is happening and bringing in stress on that part of it, that information also should be captured, and you can build your model incorporating that. That is something which we are seeing currently. Some of the MFIs have taken that initiative where irrespective of whoever is the individual going to that particular village, the data is being captured and they are analyzing it. They have set up their own analytics division. I'm not talking about AI, etc. It is human engaged who knows that locality and using that data which has been captured. So this is bringing in. On the credit underwriting, I would still say whatever interactions I have had is still very basic. Now, Kiran can disagree with me, but I would say that it is very basic, very fundamental, and lot of time it is like, chalo upar wala hai to dekh lega. Sorry, I'm being a bit instigating Kiran on that part of it, but the point is that a lot of places we have seen it. Now, Dr. Ghosh can kind of comment on that, how things are shaping up, because this event of distress is recurring. Every cyclical way, every 5 years. Why? I have not heard that answer. I talk to the industry people and they say it just happens, certain force measure happen, etc. But why it is happened, why we are not able to predict that, why we are not able to take action before it happens. So those are the questions which are there. So operational efficiency is definitely there, where you can at least control things which are controllable by you. So that would be my position.
Paritosh, if I would come to you, you know, you've been supporting the sector, you've been supporting entities who are engaged in this. From your point of view, you know, what Asim just highlighted, what are the conditions, what are the changes that you would like to sort of bring about, you would want entities to undertake, especially keeping in mind the risk that he sort of highlighted. It's sort of a cyclical, you know, phenomenon that happens. So when you are providing, when you are funding these entities, what are the risks and what are the suggestions that you're making to them?
No, thank you. I think through this cycle, I'd say that the discipline that the industry has shown towards a couple of pointers has actually cushioned the problems that could have otherwise hit us. At least, you know, where we are, we've not seen, it's not as big a challenge on the banking balance sheet. And today also, media still talks about banking balance sheets being strong, despite the fact that, okay, there is one component which is struggling. And the reason for it is two. One is that immediately after COVID, so say from 2021 to at least March 24, I think the MFI industry did a fabulous job of building its equity buffers, whether it was through acquired equity or whether it was through retention of all internal accruals that were taking place. But the kind of net worth growth that the industry saw, even after 6 quarters of going through a pain since pretty much since March 24 to now, and maybe there are a couple of quarters still left. Having said that, there is green shoots already visible that the things have started to turn, right? We've seen that the equity buffers have been able to absorb the pains that have been coming through. The second, you know, commendable discipline has been towards a self-desired goal to actually slow down the growth in the book, and to the extent that actually reverse it. And to that extent, even the borrowing requirements for these NBFC entities have come down. But, you know, it's actually turned out to be a great industry level strategy that's played out, that it's okay to sacrifice some growth, sacrifice maybe certain clients which were on the edge, which you are no longer lending to, but make sure that the NBFC entity stays liquid and stays you know, capable of absorbing losses for this period. So I would say that we've evolved from facing you know, the crisis cyclicality that Asim was speaking about, where you would see a lot of MFI NBFCs, or in general also in other NBFC industry cycles, a lot of actually entities collapsing and shutting down, right? This time, that's not the outcome. So we've lived through a pain, you know, 2 years of cycle, and the recent book that is getting lent to by the various NBFCs is performing much better than probably if you look at the static book that was existing somewhere in March 24 or June 24, right? So to the extent that we can absorb speed, the cyclicality of almost 4-5 years, I think that's a great step that the industry's moved forward. It ensures its stability and existence forever. And now I guess the next question is, how do you delay these crisis periods that are coming in, right? And how do you proactively predict them and sort of slow down the system?
So, how is technology sort of helping you, Kiran? Can it prevent, can it delay, can it avert such crises from emerging? How is it sort of helping in this transition from group to individual?
Yeah, I think a lot of credit needs to go to the jam trinity we keep talking about, right? So at the end of the day, one of the earliest challenges of microfinance was how do you identify a borrower in the first place? So till Aadhaar authentication arrived, we were still struggling with a lot of fake KYCs and some of the frauds which were very rampant because you couldn't actually identify the end borrower. I think one of the strongest role that technology has played is they've made the identification and transactions very seamless and moving the customer to kind of a self-service mode. So if you look at the entire onboarding journey, I think a lot of us here who are MFI practitioners can say that what used to be maybe a 10-paper exercise on filling forms has completely gone away over the last 5 years. A lot of us work on tabs now. The process has literally become completely paperless on onboarding. And even on the disbursement side, everything is digital. The money is going into the bank accounts of the customer, which are authenticated, reduces the AML risks. And on the servicing side, now as we are moving to, the CFSS framework on the core banking system, we are looking at a lot of MFIs actually launching customer-facing apps, which you wouldn't have imagined maybe even 5 years back that our customers would be able to, utilize a smartphone app in their own native language. I think this journey will continue to empower individual customers moving forward, and that will mean that we are actually by ourselves kind of weakening the liability model. But I think that's the way forward, right? Because that was the whole intent in the first place. I think the success of microfinance joint liability group model is that the customer will not need a joint liability group model going forward. So I think that is the transaction that is happening, and we should all be proud of the work that has been done. Yeah.
So how do you see that, Paritosh? I think you wanted to come in here.
I would have jumped in
Yes.
if you were going out, because I do want to talk about a couple of elements of technology here, right? So, of course, Kiran spoke about technology towards reaching out to your customer base, technology towards credit evaluation. From my perspective, I would say that if you look at the last 6-8 quarters, a lot of you have had to make investments towards your collection processes, both in terms of human resources as well as, just like we talked about operating expenses going up if you go from JLG to sort of individual lending. So at least at our bank, IDFC First Bank, in fact, Samir and some of my colleagues are here, we've actually invested in the last 6 odd quarters in terms of how can we improve the collection efficiency for you so that you don't have to put an army of people to just process all the cash flows that are coming on one side and the bounces that are taking place on the other side. Can we combine everything? Can we give you a solution where you give us a 3 or a 4 day window so that we can give you one output at the end of that, which is, done a lot of smart retries with various of your customers. Now, of course, all of this is based on that the customer is used to making digital payments. So I guess that's a more fundamental push that we all put together have to keep making. But yeah, the need, on the collection side also there is a lot of technology advances that have taken place.
Dr. Ghosh, if you could just come in here on the interface with technology and this transition. How do you see it sort of going forward for consumers as well as the entities that provide the lending support?
Yeah, so some aspects of technology matter more for, say, for individual repayments. So adoption of digital repayments can be a technological pathway for the transition from group lending to individual lending to happen quicker or much more efficiently. Other aspects of technology that I have not heard the other speakers speak about, so I'll say a few words about that, is household income assessment. That now that the RBI has, the regulator has suggested that the income assessment be done at the household level. By the way, that is a really a creditable move by the regulator to insist on household level income assessment. At Dvara Research, we have been advocating for household level income assessment since we started operations back in 2008. So we are very happy to see that the regulator has also moved towards a household income assessment based underwriting framework. But the regulator has not given good guidance on how to do household income assessment. And household income assessment remains a very, very difficult thing to do for even microfinance companies and their agents. So this is where I think that AI and machine learning techniques can play a significant role. For instance, we know of companies which are beginning to experiment with taking photographs of the interior of the house and building a database that will then allow them to train models to predict household income based just on visual or photographic evidence. So I think that technology can play an important role in underwriting as well, and that can be some of the alternative data that I think remains to be explored.
So can I just add?
Asim, yeah, I'm just coming to you. You flagged earlier, the whole cyclical, how it sort of, the risks sort of come in at, regular periods, regular intervals. When we're talking about technology, the interface of technology with the sector, how do you think we can use it more effectively to predict those more effectively and prevent those more effectively?
Okay, so two things out here. One, the customer has become digitally literate. The customer is digitally literate. They make that reel and TikTok and all those videos, etc., and keep posting it. Financial literacy is still a journey for them. So that way they are digitally savvy. So that is one assumption. And second assumption, and again I'm taking the customer viewpoint. When I need the money, can you get it to me? Whatever underwriting, whatever credit policy you want to use it, can you get it to me? Then technology is helping it. Otherwise it's all efficiency talk that we are talking about. And that is only increasing your margin, not for the customer. So we talked about new product innovation, etc. These are the customization of the products at that level. That is something is required, not only in the microfinance where the need is more, in all other banking customer segments also. So I would say we are just investing because RBI is saying put CFSS, so I will do a core banking. Put onboarding with KYC, video KYC and all those things, so I will do that part of it. So everything is being directed by the regulator, not by the financial institution. Customer wants more. Friction.
So what would be your suggestions if you had to sort of...
Because we are still talking about product-centric, not customer-centric. Financial industry is product-centric. We define a product and then we look for customers. And that's where this paradox is existing. All other industry segment in retail and others, they have moved ahead. We have not. Our last innovation was ATM. Beyond that, nothing. The rest all software and etc. we are doing it, credit card. That's it.
Kiran, would you like to respond here?
We can talk.
Yeah. So I think, being from India, which is so populated, 1.4 billion people, even if you look at the penetration of MFI itself, we are talking about at its peak to 2024, we hit 4.5 lakh crore portfolio. Post-crisis, it has come down to 3.4 lakh to 3.5 lakh. So there has been a shrinkage of nearly 30%. But then the spread has been so disparate, if I can talk about it, right? The southern market, if you look at it, district level penetration is topping 100% already. But lot of large swaths of northern belt, nobody has even gone, even today. So if you look at UP, for example, district-wise penetration by household, if you just assess it, it's hardly reached 30 to 40%. Bihar has been a 5 to 7 year story, so the penetration is much higher there. But a lot of areas are still untapped. So I think a lot of groundwork still needs to be done on fundamentals of doing the business and driving more financial inclusion and bringing all these households back into the financial services fold, right? Rather than going back to the money lender, how do we bring all of these households back into formal financial services? I think that should be the first target for us as a sector. And if you notice, last 5 years, the number of households that we are serving are actually stagnating. Even though we are talking about 300 to 350 million households, we are hardly catering to 60 million households. So if we were doing a good job of, expanding the presence, doing the fundamentals right, this number should be anywhere upwards of 100 to 150 million. But that's not really taken off. So there are some, fundamental, I would say, bottlenecks which are not helping us go to the last mile yet. And I think technology first needs to solve for that problem, bring all of these households into the formal fold. And I definitely agree on the next level of, iteration, right? Where like what developed countries are facing today. How do you get more products once the base products are kind of catered to? I think that's the second layer of the problem that we have to solve for. Yeah.
So to sum up, because we're coming to the end of the session, I would just come to you,
I'll
Paritosh.
just take 30 seconds to just add to what I think he's done a fantastic thing to egg all of us to look for newer products to deliver and customize them for our customers' need. But I think even from an RBI perspective, the best thing that RBI has done is that they have set up something called as RBI Innovation Hub separately. Yeah. And they've said, look, you can go there and suggest all that you want, experiment with very kind of products, and they will give you those sandboxes to sort of develop things on. And then, of course, for larger institutions, financial institutions, it will come always from, you are hereby permitted to do X, Y, Z. Right? So there's a method to getting to it.
All right, we come to an end to this session. Very interesting points, and I think a bit of challenge here for the entities over here. You need to come up with new products. Thank you so much for the panelists and all of you who were here, attended the session. Thank you.
Much, moderator of the session. Thank you so much, esteemed speakers. We'll just take a moment as we want to recognize this moment and capture it in our lenses also. Just to make this a little more memorable, we'd like to present mementos. And may I request Board Member Sa-Dhan and Chairman IDFC Financial Services Private Limited, Mr. Vivekanand Salimats, to kindly join us onto the stage. Ladies and gentlemen, this has been an very enriching and very informative session. A huge round of applause for our panelists. And we've been joined by Mr. Vivekanand Salimats. May I request you, sir, to kindly present a memento to Mr. G. Kiran Kumar. Presenting a memento to Mr. G. Kiran Kumar. We thank Mr. Paritosh Mathur. Thank you so much, Mr. Mathur. Thank you for sharing your thoughts with us. Our heartfelt gratitude to Dr. Indradeep Ghosh. We now present a memento to Dr. Indradeep Ghosh. Thank you so much, sir, for joining us. We also thank Mr. Asim Parashar. We now present a memento to Mr. Asim Parashar. Thank you so much, sir, for sharing your thoughts with us and most importantly, your time with us. Ladies and gentlemen, presenting a memento to Mr. Asim Parashar. And a huge round of applause for the moderator of the session. May I request Mr. Salimats to kindly present a memento to the moderator of the session, Ms. Deepshikha Sikarwar. Thank you so much, ma'am, for making the session so interesting. Thank you so much for wonderfully conducting and concluding the session. Ladies and gentlemen, a huge round of applause for our moderator and also our eminent speaker. We also request Mr. Salimats to now present a memento to Mr. Piyush Ranjan. May I request Mr. Ranjan to kindly join us onto the stage in case he is here inside the hall. Mr. Piyush Ranjan, we have someone on behalf of Mr. Piyush Ranjan, who just made a presentation right in the beginning of this session. On behalf of Mr. Piyush Ranjan, we have Mr. Abhijit, who's from Cover Fox, who is coming and receiving the memento on behalf of Mr. Piyush Ranjan. Thank you. We also like to present, may I have a moment from the speakers, because we would like to have a group photograph also. May I request the speakers to kindly stay back. Once again requesting Mr. Salimath to now present a memento to Mr. Mayank Jain. May I request you, sir, to kindly join us onto the stage. We had that wonderful report release, and we thank Mr. Jain for doing the honors. May I request Mr. Salimath to now present a memento to Mr. Mayank Jain. We thank Mr. Mayank Jain. Thank you so much, sir. And we capture this in our lenses. Thank you. Thank you once again. Ladies and gentlemen, that has brought us to a concluding moment of our Breakaway Session 1 in Hall B.